Today, unpicking financial stability. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, the Reserve Bank has released their latest financial stability review. It comes out every 6 months. And it's 60 pages of, well, I was going to say goodness, but really, no, it's not. It's 60 pages of waffle, frankly. And rest assured, I've read it all, so you don't need to. So what I'm going to do is to just try and call out some of the key highlights. But also I want to make the fundamental point that financial stability is looking at the structure of the financial system. It's not looking at the financial situation of individual households or businesses. In fact, there is no report published by authorities that looks in detail at individual households and individual businesses. And of course, financial stability isn't just the sum of the parts, because essentially you can obscure quite a lot as you aggregate data, specifically if you then decide to use historical information like from Hilda, which is 2 or 3 years old, and other sources. So you can construct a picture that reads well at a top level, but doesn't actually tell you much about what's really going on the ground. Now, with that warning, let's see what they actually said. So they started by saying improved economic conditions have reduced financial system vulnerabilities in advanced economies over the past 6 months. Globally, financial systems have remained resilient, they said, despite the ongoing effects of the COVID-19 pandemic, and are supporting economic recoveries. Aided by expansionary fiscal and monetary policies, output has rebounded in most economies, particularly those with a more progressed vaccination rollout. Improved economic conditions have seen increased earnings for businesses and households, strengthening balance sheets and debt repayment capacities. As a result, bank loan losses have been much lower than was expected early in the pandemic. Many banks have therefore been able to reduce the provisions they were holding against future loan losses, and this has boosted banks' profits and improved their capital positions, which in turn has allowed regulators to remove restrictions on capital distributions. However, there have been temporary setbacks given the spread of the highly infectious Delta variant of COVID-19. These setbacks have been most severe in emerging market economies, as the rollout of vaccines is generally progressing more slowly than in advanced economies. Despite some emerging economies raising interest rates to counter rising inflation, financial conditions in most of them have remained expansionary for now. In Australia, the economy is recovering well over the first half of the year, further strengthening household and business balance sheets. Economic output and employment have exceeded pre-pandemic levels, although due to some reduced spending opportunities and a degree of caution related to the pandemic, high household saving was still contributing to households building their liquidity buffers. Given the economic rebound, Australian banks had started to write back provisions for loan losses, and their continued profitability had increased their resilience. Indeed, with banks' capital ratios increasing to be even further above regulatory requirements than before the pandemic, they had been allowed and had started to increase their capital distributions. However, the spread of the Delta variant and ensuing extended lockdowns in New South Wales, Victoria and the ACT have resulted in output and employment falling in the September quarter. For the most affected households, there is fiscal support similar to last year, which will limit the increase in financial stress. Banks are offering targeted loan repayment deferrals to households and small and medium businesses, supported by regulatory actions. However, the number of deferred loans is a fraction of those taken up in 2020. The businesses and households most at risk of experiencing financial stress continue to be those in the most impacted industries, such as tourism, retail and hospitality, and those in the areas with the most stringent extended lockdowns. The major financial system risks in Australia and internationally are dominated by the effects of the pandemic. The risks to financial stability from borrower payment difficulties have generally eased but remain. Financial stress persists for some borrowers, particularly those whose incomes have not recovered to pre-pandemic levels and as a result struggle to make loan repayments. In Australia, the fall in output and hours worked in the September quarter demonstrated that the economic risk from the pandemic persists. However, the Australian financial system, they say, is highly resilient. With rapid progress in vaccinations, it is expected that output will rebound as the economy gradually reopens, reducing the risk to the financial system. But with most of the global population yet to be vaccinated and infections widespread, there is a risk that new, highly infectious or even vaccine-resistant variants could emerge, making the outlook for the economy and the financial system highly uncertain. Internationally, financial stability risks are particularly elevated in those emerging economies where the recovery in output from large falls has been less complete and where low vaccination rates leave them susceptible to increased COVID-19 cases. Financial stability risks are particularly prevalent in countries with pre-existing macroeconomic and financial imbalances, such as Brazil, Turkey, and South Africa. With interest rates projected to begin to rise in advanced economies as spare capacity declines, emerging economies will face the prospect of capital outflows and exchange rate depreciations if they do not raise their domestic interest rates, but raising rates will further delay the recovery. Some have already tightened monetary policy in response to rising inflation, delaying the rebound in incomes. In China, authorities remain focused on lowering elevated financial system vulnerabilities. Policymakers face the challenge of addressing those vulnerabilities without triggering widespread stress and sharply lowering economic growth, while also focusing on their broader policy and social objectives. A prominent example of the trade-off between lowering vulnerabilities and economic growth is the liquidity crisis facing large real estate company Evergrande. Authorities may have to choose between imposing market discipline and intervening to avoid a disorderly resolution that could trigger stress in the financial sector or real estate industries that have been a significant contributor to growth in recent decades. In general, the numerous and simultaneous policy changes occurring at this time raises the probability of unintended consequences. In a range of countries, the potential for trade and even territorial disputes remain a risk to incomes and confidence and ultimately to financial stability. Expansionary financial conditions are underpinning rising asset prices and risk-taking. Low long-term sovereign interest rates and optimism by financial market participants about business incomes have continued to contribute to high and rising asset prices and increased risk-taking. Most major equity markets are well above and credit spreads below pre-pandemic levels. Significant rises in housing prices in many economies have also continued over the past 6 months, with interest rates expected to remain low to support the recovery and reflecting longer-run structural factors. Investors have been taking on more risk to seek higher returns, for example, with greater purchases of debt issued by lower-rated companies. While rises in asset prices have been underpinned by low interest rates and expected investment earnings, some asset prices appear high given the pandemic still presents a risk to economic activity. Further, price falls could be widespread if interest rates were to increase sharply due to unexpected inflation or rising risk premiums. Sharp price falls could cause greatest harm to the financial system for assets where leverage is common, notably residential and commercial property, but even for other assets, sharp price falls could result in market dysfunction or illiquidity, as occurred in government debt markets in early 2020. And they went on to say, in Australia, there have been large increases in housing prices and an acceleration in borrowing. Higher prices have improved the financial resilience of existing indebted borrowers. However, there has been a build-up of systemic risks associated with high and rising household indebtedness. Vulnerabilities could build further if housing market strength gives way to exuberance, with expectations of further price rises leading borrowers to take on greater risks and banks potentially easing lending standards. To address this risk environment, in early October, APRA increased the serviceability assessment rate it expects lenders to use to assess prospective borrowers, thereby reducing maximum loan sizes. It is important that lending standards are maintained and that the riskiness of system-wide lending does not increase. Now, in a separate section, they also looked in more detail at macroprudential strategies across a number of countries and across the types of macroprudential controls, and they concluded that both the domestic and international experience suggests that macroprudential strategies have been most effective at addressing the specific risks they were set out to target. MPPs work by restricting the availability and or raising the price of credit to specific borrowers, and as such, their design and calibration matters for their efficacy and efficiency. They're typically designed to reduce the supply of credit to those borrowers who are contributing most to the identified systemic risk without excessively constraining other borrowers or activity in the housing market. In many instances, this suggests that the policies should target new borrowers. Policies that affect the cost of borrowing for existing borrowers can impede the transmission of monetary policy, while policies that limit borrowers' ability to refinance existing debt can hamper competition. APRA increased the serviceability assessment rate by 50 basis points in early October. This is an appropriate response, they said, to target the extent and type of systemic risk that have been building. The direct effect on the flow of new credit is likely to be moderate, but by ensuring borrowers have larger buffers between their income and mortgages and other expenses, it will ensure greater resilience of new borrowers, thereby reducing systemic risk. The maximum impact of this policy change, though, could take several months to be realised, and it may take some lenders several weeks to adjust to the new settings, and some households will have already planned or committed to purchase based on previous lending policies. Indirect effects may take even longer than the direct effects, although changes in potential buyers' expectations could bring forward the impact of the policy change. Over time, they say, if the extent of systemic risk changes, then those macroprudential policy settings may need to be adjusted, as has frequently been the case internationally. The nature of risks at that time would then determine what types of MPPs might be best suited to the situation. And they also make the point that MPP measures have often been implemented by constraining the amount of specific types of lending by individual lenders. But they say this can present two related challenges. First, such rules can limit the effectiveness of MPP and potentially even increase systemic risk if they cause riskier borrowing to shift between lenders, including to less regulated lenders. And second, certain types of MPP can potentially entrench lending market shares and diminish competition. Because lenders have different risk profiles and customer bases, the targeted types of lending will account for different shares of each institution's lending. As a result, thresholds that are applied to the lender level create scope for lending and risk to shift within the financial system. Specifically, the share of the targeted type of lending will be expected to decline for lenders that were above the imposed threshold at the time that it was implemented, but could increase for other lenders as those riskier borrowers seek out loans from unconstrained lenders, as has occurred in some countries. Risky lending could also shift to non-bank lenders that are not prudentially regulated. The scope for this to increase systemic risk in Australia is, they say, limited. However, as APRA's reserve powers would allow it to regulate the lending activities of non-bank lenders if they were to become large enough to pose material risk to the financial system. The differences in lenders' shares of high debt to income and high loan to value ratio lending can be demonstrated with the APRA data. For example, in the June quarter of 2021, loans with a DTI above 6 accounted for at least 10% of mortgage lending at 60% of lenders, and at least 20% of mortgage lending at 20% of lenders. This highlights the uneven impact across lenders if debt-to-income restrictions that limited the share of lending that could occur above a given threshold were imposed. And similarly, loans with an LVR above 90% accounted for at least 10% of mortgage lending at 40% of lenders, and at least 20% of mortgage lending at 15% of lenders. Measures that impose constraints at the institutional level can also diminish competition in the lending market by constraining the growth of some lenders' loan books. The investor and interest-only limits previously imposed in Australia were criticised by both the Productivity Commission and the ACCC for reducing the degree of price competition in the mortgage lending market. But the RBA found evidence for only a short-term decline in competition for interest-only loans and no evidence of a statistically significant effect on competition for investor loans. However, it is worth noting that competition and financial stability objectives can at times conflict with each other. For example, in circumstances where strong competition results in weaker lending standards. Under those circumstances, the benefits of supporting financial stability with MPPs could outweigh the costs of competition, particularly if those costs were temporary, but a careful assessment of this trade-off would be appropriate. Now, standing back, let me make 3 points. The first point is this, that clearly the bank is trying to justify in retrospect what it's done and what it hasn't done. Remember that the main reason why we have such a boom in mortgage lending is because rates are so low and lending standards are so weak. I've demonstrated that in all of my modelling quite recently, and I'll refer you to a recent show where I discussed in detail what the levers were in terms of why home prices were bouncing much higher. And the critical issue to understand is that availability of credit is the most powerful lever of all. The second point is they're talking at the macro level, and they do define stress in a very particular way in their analysis. So people are defined as stressed if they miss a mortgage repayment. But of course, that is not really the point. And in my analysis of stress, I use a very different methodology, because what happens is if people are in a financial bind, they will prioritize making the mortgage repayment over other things. For example, they will eat less, or they might forego medical care and attention that's required simply to maintain those mortgage repayments, because you have to look at household budgets in the round. And that's what our mortgage stress analysis does. And by the way, I'll be making a show shortly on the September results of our mortgage stress, which showed a slight increase from last month. The third point is that the focus of both APRA and RBA, and remember that they claim that they have no responsibility for house prices in any way whatsoever, despite the fact that they control the credit environment. The fact is, they focus very much on new loans and claim that controlling new loans is critical for financial stability. But we know from our surveys that there are a lot of people whose incomes have been considerably crimped compared with where they were before COVID. And because of the fact that incomes and expenditures are two parts of the same equation, if incomes are compressed, then more people are going to be in financial stress than is being accepted by the regulators at the moment. And if they are really then looking just at new loans and trying to tweak macroprudential policies against new loans, they are really missing the point, because only a small proportion of loans are new. The bulk of loans on the book are actually ones that have already been written. And in our analysis, we know that there are quite a few households who've got loans from perhaps 2 or 3 years ago and who are really struggling now. Not many of them can necessarily refinance to a lower rate, and so they're locked into higher rates, and their financial pressures, therefore, are building. And the other point I want to make is that the RBA consistently uses out-of-date data from Hilda, which is an interesting piece of analysis, but doesn't reflect any of the impacts of COVID. And also, they tend to analyse risks by looking at mortgage-backed security portfolios. Unfortunately, those portfolios are myopic because they're hand-picked portfolios by lenders with a particular type of borrower. and they don't necessarily tell the full story. So my problem with this whole financial stability conversation is that it's too high level. It focuses very much on the risks at the structural level, which are important, but misses completely what's going on the ground amongst real households and real businesses. And I think it's disgraceful that the Financial Stability Report doesn't go where it should go, which is to look at what's really happening to real households and real businesses. But then I suppose you could argue that that's why DFA is here, because that's precisely what we do. We go granular because we need to understand what it's like to be an individual household or an individual business wrestling with the mismatch between incomes and expenditure in a low interest rate environment, but one where rates could rise and where the average mortgage is way bigger than it used to be. Those are the things that ultimately flow through to financial stability. So my bottom line takeout from all of this is they start their discussion of financial stability in the wrong place. They come top down. What they should be doing is going bottom up. That would give them a completely different view, but a view they prefer probably not to see, because it would suggest that, one, they created a lot of the problems, and two, their policies are misaligned to what is needed to take us forward into the future. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.